All right, everyone, welcome to this episode, I guess, webinar, channel chat. I'm Kavita May here with the GTDC. We host these alongside our IDC partners. So thank you everyone for joining. We have with some great content to share here. We have Loren and Mary, and but first, let me go ahead and bring Frank on so he can get us started.
Thanks, Kavita. Appreciate it. So I'm going to go kind of quickly. We're going to cover 3 or 4 things today, and I want to leave enough time for Loren and Mary to cover the IDC content, which is very interesting. So if you go to the next chart, by the way, Loren, go back to that chart. Loren has been the host since the beginning from IDC, and he's their VP of Data and Analytics, and has helped us from the start. Mary, I believe this is your first time joining us. Mary's VP of Worldwide Infrastructure Research, and we'll talk a little bit about the trends that she's seeing, particularly as it relates to AI and AI adoption. So let's go to the couple of GTDC charts first. So the first thing I want to tell everybody is many of you know about our training course. It's gotten very good reviews, recently been updated for a lot of the SaaS content. We've got new courses starting on September 17th. So, access us through gtdc.org and our Knowledge Hub, and you'll be able to get yourself scheduled for the courses. If you go to the next chart, we are happy to announce that we finalized the date for our summit in 2025. It'll be February 19th to the 20th. It'll be in Oceanside, California, which is right outside San Diego. We went there last year. Great location, very quick from the San Diego airport. And it'll be, 2 really good days of content, of collaboration, of networking, and save the date, because way more to come. But we're happy to have the dates locked in and looking forward to that. Registration will be opening in the fall. And then finally, we continue to provide content into the marketplace. These 4 studies, or 3 studies, 2 studies are out and 2 are coming. Beyond the Marketplace is out there. It talks about how distributors help empower your journey through the IT acquisition phase and implementation phase, of course. The second study, A Vendor's Guide to Market Data, talks about a lot about our partnership, frankly, with IDC and Context and GfK in Europe in providing data that's very usable for you all, helping you drive your business. And then we've got a cybersecurity study coming in the fall. And then we will start a regular series of AI adoption articles and blogs, etc., here in the fall also. So look for those. So with that, I know Kavita has a couple of questions as it relates to AI that she wants to ask for some input. So I'll turn it back over to you, Kavita.
Yeah, so we have some quick questions here. You guys can see here. You can also maximize the screen, I think, hopefully, and you'll be able to see the 3 questions we have. If everyone who's on this call and feels comfortable answering these, if you guys could take just a quick minute. We're using these responses to put together the study that Frank mentioned on AI adoption. So all the input we can get is really, really welcome. So as you can see here, the first question is, how's your company currently utilizing AI technologies? And if you guys can choose all that apply here, so you can choose more than one. And the second question is, what are the most important services that the distributors can offer vendors? And then the third question is about the percentage of your partners that you believe are actively integrating AI into their offerings today. And that's a single choice answer. So Andrea, I think you can take a look at who's answering, et cetera, et cetera. So whenever you think we should stop the collection, and we'll give it another 30 seconds here, maybe.
I think we're good. I'm going to go ahead and close out the poll.
Okay, thank you, everyone. I appreciate it. And Loren, back to you.
Great. All right. Well, thank you guys for that intro. I think the GTDC events and research are going to be really good quality content, and hopefully the survey results are also useful. All right, so I'm going to transition now to a brief macro market environment summary, and then we'll get into the actual latest results from the North America Distribution Tracker. So this is, really 30,000-foot view, just updates on some of the things that we've covered in the macro view in the past and putting it in the context of recent news. So recession risk remains a top concern in a lot of places, but it's dropped pretty substantially, particularly in North America. So coming into the new year, you can see in our Future of Enterprise Resiliency surveys that recession risk or expectation of a recession dropped from over 80% in North America last year down to less than 30% this year. And it's crept up a little bit. Obviously, we can get into, the various factors, whether it's survey or economic and political environment, the world, global economy that affect that. But it's relatively consistent and optimistic. Asia, in comparison, had a surge in recession risk worries at the end of last year. That more or less coincided with the worst of their real estate fears, but it's come down a bit. And then Western Europe, in comparison, has remained relatively high and oscillated a bit. A lot of that is related to the wars in Ukraine and the Middle East, as well as their dependence on energy prices and so on. It's interesting to note, and I've highlighted some of the numbers in Europe there, that although they're higher, the long-term trend is actually down. So the higher numbers, sort of the odd numbers, 65, 64, 62 are trending down, and also the lower numbers, 59 and 57, are trending down. So there's a higher risk, but moving in the right direction. Another way to look at this is the GDP forecast, and we continue to expect a soft landing scenario for the US, which seems to be widely accepted. It's interesting in context of things like recession or interest rates or employment, where we've seen persistently high interest rates and actually rising unemployment, and those are seen as risks. Actually, if you look at, the sentiment amount around potential recession risk, to me, it seems relatively high if you look at these global GDP numbers. Worldwide numbers are pretty stable in the 3% range. The US is stable around 2%. And we've got some optimistic outlooks in markets like Western Europe, Middle East and Africa, and Canada. So there's a little bit of volatility. We're mostly going to focus on US and worldwide, but I think it's good context for a relatively stable and even potentially improving economic environment globally. So just to dig into that a little more and transition to how it applies to tech spending, I've shared the results of this question in past presentations as well. And what I want to highlight this round is that we're starting to get a mix of IT and economic factors. So 6 months ago or more, we were getting predominantly economic risk factors. And then more recently, we had a month or two where we got predominantly tech factors. And now we're kind of seeing those mixed. And to be fair, they're all in the 30+% range. So there isn't a big difference at this stage. And even in past presentations, the top score was also 30 plus, but some of these factors were just in the high 20% range, so not necessarily that far away. But there's I think aside from the shift in the balance between tech and IT priorities, the thing I would add is that there's just a lot of priorities. There's uncertainty. There's many different types of tech that folks are wanting to deploy that are competing for budgets and priority. And similarly, on the economic front, the story is not told by a single number, whether it's GDP or recession risk or unemployment or so on. So, I guess just that dynamic, complex environment is a key takeaway. Again, developing how this impacts IT spending. So this is our, 30,000 foot total IT spending globally projection. And it's the blue line, solid blue line. We have a downside scenario in dashed blue, and you can see the GDP forecast in green with major highlights. The main thing to point out is in the more recent versions, AI investments have boosted that spending, and that although we expect GDP and IT spending can improve, there's some, let's say, reduction in flexibility and elasticity of that spending that I think we've had early stages of hype for AI where money and budgets were just shifting sort of dramatically. And I think now we're starting to see a little bit more measured pace and trade-offs between different priorities. So most of that is summarized here. Economically, just kind of hitting some of the highlights. Economic growth was resilient. Recession risk is lower. Some of the data is patchy, and there's vulnerabilities like Europe. We have some downside risks, which include election results, energy prices, and inflation. IT spending largely is in line with expectations. We do have some reshuffling of priorities. So example is server and software grew faster than forecast. Actually, in the latest NADT results, we have server shipments growing more than 35% since about mid-February, year on year. So that's a pretty substantial jump. Enterprise spending is resilient, but it's also price sensitive. So, we're seeing that balance and reallocation between projects. There's optimism that interest rates will start to fall in the second half of the year. There's other drivers, whether it's PC replacement cycle, AI PC adoption, refining of AI proof of concepts, broader enterprise spending, etc. So we do expect IT and AI spending to outpace GDP growth and productivity. That'll be most visible in countries that have strong government support for those types of products, and where there's more cloud optimization. Digital transformation continues. I think there's been so much focus on AI that sometimes we lose sight of the broader digital transformation initiatives, but it's important to remember that enterprises have lots of different priorities, and so their AI is a big one. It's not the only one. I already talked about price elasticity, and so it's the trick here is balancing all of those factors when managing the risks. Okay, so that's kind of the macro environment. Let's dive into specifically the North America distribution tracker results. This is data through week 28, which is the first couple of weeks of July. So, very fresh. At a top level, this is showing year-on-year growth rates for year to date. So through week 28 for all of the years. And we can see in 2019, we had consistent growth across categories. As we went through the pandemic, we had kind of mixed results with stronger growth in consumer first, and then a little stronger growth in enterprise second. Where we are right now in 24, the biggest change is that personal computing has now turned positive again. And most of the categories are above where they were in 2023. So just look across that list, you'll see not only PC, but software and software services is actually down a little bit, I believe. But AV and consumer, the big one that went down is infrastructure in orange. So you can see the three on the left is AV, infrastructure, and others. With the exception of infrastructure, AV and others are down, but they're better than last year. And infrastructure is mostly down because of network equipment, which had a really tough year-on-year compare. But it is a spot of weakness. So trend-wise, we're looking here at in blue, the actual weekly revenue, which, has some volatility as we've seen in the past. The orange line is the year-on-year growth, and the dashed orange is the trend line. Week 27, so just the second to last week in this data, was up 27% year-on-year on top of previous growth the previous year. So that's a very strong result. It's actually the highest weekly revenue we've seen from NADT so far. So, really a strong signal. If you look at the red dashed line on the bottom, you can see that we had 5 quarters where the beginning of the quarter saw a decline of 20% year on year, with limited upside. And so that was a real anchor pulling down the overall results. If you look at that green dashed line and the green circle, you can see that now in the second quarter plus of 2024, that we've kind of broken that cycle. Not only did we hit a new high, but the trend is turning positive. So we're going up. Now, we do have the last 3 or 4 weeks, we saw positive growth, but, mid single digits, not plus 27%. And total year to date was, total Q2 was actually up less than 1%. So still relatively modest. A little more context, I've just added a rolling 4-week view, and here I've added some trends. So the most recent weeks averaged around 6.4 billion. That's on par with average volume in 2022, which was our peak year. So that's a pretty solid result recently. If you look at the green dashed lines at the top, you can see that most of the years are seasonally smaller in the beginning of the year, rising towards the second half of the year, and that 2022 at the peak was really an exception in that trend. And so where we are right now, it looks like we're primed for a fairly strong second half of the year, and that can lead us to potential growth. We've only in the last 15 weeks, we've had primarily growth quarters and only a few year-on-year declines. So as we've done in the past, I've also looked at this on a 2-year combined level, and that's a technique to kind of normalize when we've got rebounding markets. So just like the 1-year views, this time we hit an absolute record in week 26, reflecting overall strength in the market, even though the total growth trend line is still negative. That should obviously pick up going forward. And then you can also see in the green line that the volatility has declined, which is a good sign of stabilization and overall trends. The 2-year view also reflects a much more stability. The topics that we'll get into in more detail in subsequent slides is that we've seen significant recovery in the consumer devices and a little moderation in enterprise spending. The fact that we're still at negative growth, despite some early positives, mostly reflects just the nascent stage of, early stage of this recovery, let's say. So lingering economic uncertainty, just getting the market to see some actual reduction in interest rates, to get past the elections, to get, other hopefully positive news, to let consumer device spending grow, and to see how enterprise spending evolves. So this is same view as the similar view to the year to date I showed before. This is actually full calendar year. I want to point out 2 things. The first is that this is our forecast from April, which is going to be refreshed in just a couple of weeks. So don't hang on to this data too closely. The other point is, if you look at the green circle, that's the forecast for 2025, and we have growth across all categories. And so that's a pretty significant milestone. I sort of here unofficially dubbed it post-pandemic, where I think we're finally going to be starting to get out of the cyclical response nature from pandemic disruptions and hopefully into a more steady state level of IT growth. Now, obviously, there's lots of other factors, all the risk factors, even the tech factors that we've talked about that are going to throw us curveballs. I'm sure it's not going to be smooth, but hopefully more smooth. Okay, US versus Canada continues a lot of similarities with the US. The relationship, as I've pointed out in the past, depends a lot on the exchange rate with a lag of 2 quarters. So that exchange rate is shown in the green line, and then you can see Canada in blue and USA in orange. If you look at the middle chart, which is the rolling 4-week view comparable to what I just showed you, Canada also saw really big growth in the first half of the year. They went from -17% growth at the end of 23 up to +7% in week 14. And then they've come back down. And so, a good sign, but we're not off to the races yet. The second point that I want to make, you can't see it just in these slides, but if you were to compare to the last webinar, in those slides, Canada's trends were ahead of the US curves. If you look at these, you'll see that the US is leading. So on the left-hand chart, you'll see the red, orange, and blue lines dip in late 23 and then rise, and you have orange and red leading with blue Canada following. Similarly, on the right-hand side, orange and red dip a little bit lower, but they're actually more positive than Canada right now, where Canada in blue is just kind of bottoming out, and we would expect to turn the corner and rise and see future growth like the overall market going forward. Okay, so breaking this down by technology, I mentioned verbally a moment ago that the consumer devices had kind of turned the corner. You can see here that all of the consumer device categories, the PC in yellow, AV and CE in blue, even others, which is in gray, it's not called out, all of those turned positive and brought the overall market positive. Software in green and services remained positive. Software stabilized. Services had trended down. We'll look a little more at that detail in a coming slide. And then infrastructure is the weakest of the bunch, negative, but also turning the corner, flattening out. If we look at these on a 2-year basis to normalize those rebounds, enterprise remains stronger in the 2-year trend, so you can really see that software and services not only lead growth, but their trend lines are much more solid. Infrastructure, which is by far the weakest in a 1-year view, is actually still among the top 3 in the 2-year view and turning up. So, providing that context, I think, helps understand that it's actually still a relatively solid market. And then the consumer devices, the dashed lines are turning up. We do still see that the AV line in blue is trending down. It looks a little more dramatic there because the recent growth that pulled up the 1-year trend is kind of being outweighed by older data. But I think it's a really good illustration of how these two views can work together to reflect the market trends. All right, let's jump into software. So first of all, the red dashed line in the middle is overall spending growth that rose to 8% for the past couple months, rebounding from a low in mid-23. So, solid overall trend. System infrastructure remains the dominant category. It's gained share to about 61% of spending. which is up from about 57% several years ago. So 4 or 5% growth. It's also leading growth now recently. So apps is the other category that took a big positive shift. So it's now +4 from a pretty dramatic decline at the beginning of the year. However, there's been some weakness in recent growth, and year-to-date sales are actually down 21%. So even though the trending-wise, the trend here is going to reflect precisely that trend. So where we had even worse declines months ago, now we've got smaller declines or minimal declines. Year-to-date sales are still down 21%, and yet the trend is starting to show growth. So directionally, it's right, but again, you want to look at the context here. So in comparison, first, let me point you to the green circle on the left. So both apps and other software had outlier weeks or a couple of weeks where they sold pretty substantial revenue. The trend is fairly different in both of those cases. So as I pointed out, in the case of apps, huge growth at the end of 22, beginning of 23, and flatter volume since then, with year-to-date sales down 21%. If you look at that orange line for other software, the surge was more recent. That dashed orange line kind of in the middle reflects just the upward trend, and actually year-to-date sales there are +21%. So, much more positive trend overall. App deployment and development is the final category in lighter orange or yellow. The seasonality throughout has been more stable. We have had pretty substantial declines year on year in May, but year on year is just down moderately. So lots of dynamics there, but overall, pretty solid software trends. This is the 2-year view, or the middle chart, and the bullets are 2-year. The left-hand chart is the same 1-year view, just for comparison. And here you can really see that the other software category is much more stable and positive in the 2-year view than it looks in the 1-year. It's leading growth and risen above 20% more recently. Similarly with app deployment and development, the lighter yellow line, much more stable and positive trend. So overall, we still have the right-hand red dashed line looking stable and moving up. In the 2-year trend, the apps view is still negative. It's more bottoming out. This is another one of those cases where recent positive results haven't been substantial or plentiful enough to kind of really turn that 2-year trend, but it will come. So shifting into software, software had some similarities services had some similarity to software. Overall, trends were relatively stable. In this case, as I pointed out, they just slipped below 0 in the most recent week, so a little bit more negative. We have had extended service agreements and phone consulting, the orange and lighter orange lines, pulling down categories, but our top category, which is others, continued to pull away. It's gaining share, year-to-date growth of 16%, and on top of 27% growth in 2023. So this compounding growth is really making it a larger category, and the trend is quite positive, above 10%. The trend for warranties looks pretty solid, reflecting peak shipments in October, November. So again, I'm going to direct you back to that left-hand chart, and you can see the green circles around kind of rising shipments earlier in the year. So 21, 22, 23. But then in 24, that red circle, we kind of missed that significant bump in shipments early in the year. And so what we do see is the end of 23 and around week 19, 24, we see a surge in shipments, that horizontal oval, let's say. But the gap in early 24 and potentially what we need to see in the coming weeks is will there be another, bump up, or will there be a surge? That'll really determine the performance and trend for warranty. So year-to-date revenue is actually down 7% year on year. It's those big peaks that make it look high in the trending line. Okay, and then other support is a little bit lost, and it's a little harder to see in dark gray, but they had a solid rebound and 12% growth year to date. Again, we're going to compare services to the 2-year view to the 1-year view. So in this view, you can see that the recent weakness in warranties shows up as a clear drop in the middle chart. So definitely some weakness there, but you can also see that it's been following a couple of years of pretty solid growth. The declines we see or weakness we see in the 1-year chart is much less in the 2-year chart in the middle, and others looks even more stable and solid with the dashed line trending above 20% for the last couple of quarters. All right, let's jump to PCs where we'll wrap up. So PCs looks real solid overall. You can see on the left-hand chart, well, both charts, you can see a substantial decline in 2023, which is now giving way to a fresh wave of growth. So revenue reached almost 930 million in week 26. That's the highest we've seen since mid-22, which was really the peak of the growth. And we've got the trend surging to over 20%, which we haven't seen in quite a while. So the overall PC trend is in red, is following closely the notebook trend in dashed blue. We saw similar trends in many of the categories. Desktop and workstation also hit multi-year highs, but the variation wasn't quite as large. We do have some spotty growth in recent weeks, which shows those trends as turning down. Tablets also turned positive, and then which you can see in gray, and then PC others, which is a very small category you can see on the bottom left, has remained negative on the trend line, but it is turning up. So we have let me actually transition into the 2-year view. But as with the others, we get a lot more stability in the 2-year view. The short-term growth and improvement in the trend that we're seeing is much more muted in the 2-year view. So overall growth is not quite positive yet, but we're looking at strength across these different categories. Let me just add, I guess, we've what's driving this. So, I mentioned earlier, we're potentially getting into a post-pandemic phase where the rebounds and ramifications of supply chain disruptions and demand cycles from the pandemic are passing us. So in the case of PCs, this was one of the most affected categories, where we had an initial drop in 2020, and then this huge surge, which was most dramatic in workstations, but really also in the other categories in 21 into 22. And then for the last year and a half or so, there's been a significant reduction in demand and an effort to reduce supply. And so we're now, inventories are falling, supply chain is normalizing, and we've got some new drivers. So we've got AI PCs coming in, which are boosting not only demand, but ASPs. And we have pending end of life for Windows 10 late in 2025. And so basically between now and then, we're seeing and expecting a lot more commercial replacements and investments. So put that in the context of strengthening economics, and you've got a recipe for improving growth, which I think is probably the main theme from this summary here. All right, so that's where I'll leave it for the NADT results, and I'll pass it to Mary to talk about AI's impact on the market.
Great. Thank you so much for inviting me today. And, if you want to go to the next chart, I'll just briefly say what I want to talk about is a little bit on the status of where the industry is with AI proof of concepts versus moving to production. Because I think Frank and I even were having this conversation right before the session that there have been some hiccups and maybe slower adoption than a lot of folks thought, particularly in the vendor community, thought they were going to see over the last year. But there is progress being made. But I also want to put this whole, oops, you went through a bunch of slides really quick there. You can go back to the agenda real quick. There you go. I think it's really important to understand that all the energy around infrastructure as it relates to AI, it's part of a bigger story that has to do with ongoing commitment to hybrid and multi-cloud interoperability, and also has to do with data and the decisions organizations are making about data governance, data logistics, and other elements of infrastructure modernization. So I'll try to go through this in the time we have, but if you want to go to the next slide, when we talk to organizations broadly about all things infrastructure, so compute, storage, network connectivity, cloud, what we hear them say again and again is that looking out over the next 18 months, the most important thing to them, or important things, are developing a strong business case for this AI infrastructure spending, because again, they're seeing a lot of interest in AI, but there isn't always a good, solid justification model for the infrastructure spend that's required, and coming up with appropriate ways to match that infrastructure spending and investment to that business case. But they're also concerned about cyber resilience and security. They continue to be concerned about sustainability and power and cooling efficiency. And like I mentioned, data storage, data management, and also the governance that has to go around all of this, because a lot of the decisions now being made about infrastructure are data-driven, data first, and the rules, the responsibility, the access, the security around that data is really critical. So if you want to go to the next slide, in looking at who's actually successfully moving, particularly Gen AI, from proof of concept to production, our data in April was about 15%. I think more recently, maybe it's up to maybe 17%, but it's certainly that range. And what we're finding is that among those organizations that have moved to production, they've typically run as many as 50 different proofs of concept. And those can really vary. Some of them are simply activating a Copilot or some other sort of built-in add-on to a SaaS service. Some of them are, using Gen AI to develop code. Others are, building from scratch or creating small language models, or taking large models that exist and training them in the cloud, and then maybe them moving to on-prem for production and inferencing. So a whole bunch of ranges. But what we're typically finding is that about 76% of those POCs meet their targeted KPIs, and then about 6 move to production. Now, in some cases, they've combined several proof of concepts into one production launch. You go to the next slide. I think it's important to remember that, infrastructure is continually cited as one of the top 3 reasons that organizations don't always successfully make that transition from proof of concept to production. I mean, certainly there's concern around lack of developer skills, a lot of concern around costs, as I mentioned, and trying to really understand what's the right set of trade-offs between the expected business outcomes, the cost of the implementation, running it at scale, keeping it secure, and then also the time it takes to the value, because even within successful POC that has a reasonable ROI, there's still a lot of decisions about what's the scale of the infrastructure we need. Do we really need to run the whole thing on a very, very, very large, high performance set of resources? Or is this something that can be met almost as well? It might be a little slower, but better ROI using a small language model. And what are the requirements around the data sets and the user bases in terms of security, logistics, resilience, data sovereignty. So a lot of different things go into the mix. If you go on to the next one, I think what we find is that when they start to move from POCs to production, there's often a big choice around, well, where is this going to get deployed physically? And as I mentioned, security, sustainability, network costs, supportability are all going to factor into that conversation. But on the next slide, first and foremost, though, when it comes to AI, it is so much of a data-driven conversation. We continue to have input from customers that says, I still am not getting the full value out of, a third or more of the data I've got today. And I've got data silos. They make it hard to integrate. They make it, again, hard to get that value. And now I'm looking at AI, and I'm expecting that I'm going to have, models that are updated weekly or even more frequently. 70% think that. 57% think they're going to do at least some customization or fine tuning of existing models. 77% is the amount of unstructured data that's going to be in the mix. So again, we've got all kinds of formats, all kinds of locations for various content that's going to flow into AI. And it's going to take place across a hybrid and multi-cloud environment. Because again, those data assets are sitting in public clouds, they're sitting in SaaS and platform services, they're sitting in on-prem, they're sitting in very traditional data environments as well. So making a set of assessments around for any one AI workload, what does the data portfolio look like? Where is it gonna, where is it going to reside? How are we going to maintain the security and resiliency around it? That's a fundamental set of conversations that customers are having right now. And I think they're starting to look at partners and certainly, beyond just their big cloud providers, but also the folks who really know their industry and know their data to help them with these conversations. If you go to the next page, in terms of the infrastructure, it's very clear it's going to be a very hybrid and multi-cloud architecture. And again, customers are really looking for guidance around what's the right place for different kinds of workloads. Typically with that data first conversation, what we're seeing is that dedicated either on-prem or hosted data centers are typically the place where that, more confidential, more regulated, more privacy-oriented type data, where those use cases are going to reside. But again, there's a very large amount of AI that is really running on embedded infrastructure that's part of a SaaS or a cloud or an AI platform service. And so it's always important in talking to customers about how do they expect these to interoperate? How do they expect the AIs that are taking advantage of that proprietary confidential data, maybe that has to run in country in different locations. How are they going to work with that and connect that as appropriate, at least the output and the workflows to some of these other services? So depending on the customer, depending on the use case and the data, you're going to see a big mix. The one thing I will see is that among organizations that have successfully moved from POCs to production, we are seeing a little bit higher tendency to do that model fine tuning in an on-prem location. And again, I think that has to do because of the confidentiality of the data. And in some places, it's because it's also running on smaller models that may lend themselves to running on existing infrastructure assets, particularly in the early stages. So moving on, I guess the real point I wanted to make is that for most organizations, it's not all about AI on a big GPU cluster. There's a whole lot of conversation going on about storage, about data logistics, about how to seamlessly integrate data and maintain data portability across all these different platforms and services that I was just talking about, and also making good decisions about when to invest in dedicated storage capacity as these AI systems themselves create more data and information that has to be retained, maybe built into other workflows, and the whole complexity of the storage infrastructure, I think, is something that many organizations are really starting to look for help with, along with how they update their data storage and their retention policies, how they decide how to govern data moving to the public cloud, and do they need to migrate to a new generation of storage platforms like all flash storage. Moving on to the next one. All the things I just talked about, I'm sure for many folks bring to mind cost. This is going to be really expensive. And in fact, in our surveys late last year, what we saw time and time again was an expectation that half of AI spending in 2024 was going to be on infrastructure. I think many organizations, that's been this hurdle to get over. And I think that's why you're seeing a lot of energy around prioritizing private Gen AI running with smaller language models. We're seeing increasing interest in AI PCs and AI workstations, particularly as part of an inferencing conversation. And we're also hearing folks, I think, start to connect this AI infrastructure conversation to their broader infrastructure modernization conversation. So they're looking at, can I reuse existing platforms and technologies and current generation of technologies that my in-house people already know how to run and maintain? Can I use that for certain kinds of AI use cases? And again, we're looking beyond just Gen AI increasingly to more traditional predictive style AIs that run on more structured data in some cases. They're also talking to us about eliminating tech debt and consolidating systems, in part to offset and free up spending for these AI investments down the road. So it's a real balance of trying to determine what is the reference architecture and the performance and power style requirements that govern where a workload needs to go. And then again, making that sort of business and time to value and financial trade-off in a way that allows organizations to knit the AI infrastructure investment into their broader infrastructure operating model. So if you want to go to the next slide. As I mentioned, server modernization is becoming a recurring part of this broader assessment. And again, some of it is just to free up money. Some of it's to eliminate tech debt. Some of it's to make it easier to integrate and modernize applications and workloads so that they can be part of the AI community. But what we're seeing is worldwide, about 75% of organizations are telling us that server modernization is one of their important priorities this year and going into next year. That's particularly true in Europe and in Asia. It's a little less true in North America, but still more than half of the organizations in North America have it on their priority list. So I think that's something to explore with your partners and customers in terms of how are the tech buyers really looking at server modernization and the evolution and of the storage environments too, as part of the broader AI strategy. And so as we kind of go through a couple other things here, I just want to hit on the next slide, this tech debt elimination, data center consolidation, improve sustainability, simplify management and operations. It really is an ongoing thread in most of the conversations that we're having with organizations, even those that are so terribly excited about AI and can't wait to really expand it out. They recognize that they can't just run at production. They can't run AI in a silo and all on its own. In a POC, sure, you can probably get rid of that. You can spin up a cloud environment. You can run it in a dedicated stack. But as you move to a more interoperable platform kind of style world for AI, where different kinds of data is integrated and accessed by different AIs, and the actual infrastructure needs to be more shared and scaled for production. I think a lot of these, core conversations around sustainability, tech debt elimination, simplifying operations are going to continue to be very important across the tech buyer community. So with that, I'm just going to leave you with the thought that, certainly as we talk about AI, 85% of the organizations we speak to worldwide, they do see AI and Gen AI as becoming a strategic workload, but they also think it's going to need a real clear vendor and partner and supplier strategy that looks across infrastructure, software, data, cloud services, to really help them understand how to create that next generation environment that's fit for purpose, that can support those high performance workloads, that can support the small AI workloads, and that can support and integrate all the existing workloads. So a lot of the conversation is going to be about modernization, about simplification, about automation, pretty much wherever organizations are in their AI lifecycle. And I'm going to wrap up with just the last slide, just to let you know, this is a set of research that we work on an ongoing basis. We're about to begin a set of deep dive interviews and surveys around infrastructure buyer adoption trends through a multi-client study, and that data will be becoming available in October, if that's something that's of interest to the audience here. With that, I'll turn it back. I'm not sure who it goes back to. Loren?
Yep. Actually, we just have a couple other sort of info slides here. This one is on the North America Distribution Tracker, which I presented today. Obviously, I presented a really top line view, but there's 10,000 product brands and over 400 product companies in the data set, and lots more detail should you want to access that. And then Mary has her contribution to a range of IDC services. There's research, there's data and analytics portion, and there's custom opportunities that all relate to AI. We really have a broad suite of AI information if you need any additional detail about that. Just reach out to us, and thank you so much for joining us today.